Thank you everyone for joining. It's a delight to be here. It's Rebecca Rettig's birthday, so let's just pause for that moment and celebrate. That's my daughter. She's supposed to be outside. Jim, you asked me what the CFTC has done with DeFi. Should I jump
Wait,
in?
somebody has asked for us to start from the beginning. Ryne and Katherine said some great stuff. I'll start really quickly. Jim asked me to define DeFi, so I'll do it real fast, which is it's the same definition I gave at the SEC roundtable on DeFi, which is it is a software system based on permissionless blockchain networks that allows users to engage in economic transactions in a self-directed and self-custodial manner without the need for traditional intermediaries. And I said, there is rarely a industry definition that everyone has agreed on, or even a regulators or policymakers definition that everyone has agreed on. So there are nuances around it, but I think that encapsulates a lot of the main features. Katherine, did you want to say your 2-second thing, and then we can go back to
also a super amended version, but the salient points are that the regulatory environment has dramatically changed. And the new SEC chair, Paul Atkins, outlined a potential innovation exemption aimed at protecting developers and enabling new blockchain-based systems to thrive. He actually made those comments at the SEC's DeFi roundtable, at which Rebecca spoke at, actually opened the roundtable. And him and Brian Quintenz, we are both cautiously optimistic that there will be a lot more transparency and proactive engagement with DeFi, as opposed to under the Gensler administration, where there was a series of existential developments that compromised DeFi's very existence because it imposed rules that DeFi as an industry could not adhere to, even if it wanted to. But I think then we moved on to Ryne, who wanted to opine, given his CFTC experience at the commission, on that perspective.
Thank you. I will jump in there. So the CFTC regulates derivatives. Katherine mentioned the SEC Chair Atkins is kicking around the idea of an innovation exemption. We do think that's real. It's not going to be tomorrow, but I think they're working on something, or they're open to our ideas too. On the CFTC side, the CFTC regulates the derivatives markets. They regulate trading, they regulate brokers, they regulate exchanges, they regulate clearinghouses, and all four of those are functions that, if you look and strain your neck a little at DeFi or decentralized exchanges or DEXs, there's a form of derivatives trading that is very active in DeFi. Some of the biggest DeFi projects are DEXs that offer perpetual swaps. The CFTC has been expressed in saying those are derivatives, and they are subject to the CFTC's regulation, again, around trading, brokerage, exchanges, and clearinghouses. The trick with DeFi is the argument that and Rebecca teed this up in her definition, is that, look, it's not custodial. These are software that folks are using to hold and allocate or trade their own assets. There's no centralized entity doing anything that would be custody or brokerage. And to the extent there's smart contracts, which are the decentralized exchanges that let you enter into trades, again, that's bilateral trading. That's not a many-to-many trading environment. And the CFTC has looked at that for many years now, and they've brought a handful of cases. I won't go through all the cases here, but the CFTC has been decently skeptical of the idea that decentralization is really there. They're looking at founders, developers, they're looking at users even, they're looking at the governance bodies around these decentralized exchange structures, and they've brought a range of enforcement actions, usually charging folks either with being unregistered brokers or unregistered exchanges, or both. I think the CFTC, they are open to exploring how to get this right. But right now, if you go into the CFTC with a DeFi product, you are probably deciding to just block the United States. The CFTC gets new leadership soon. The chairman nominated by the current White House, Brian Quintenz, is meant to come on board hopefully soon, hopefully July or August. And this is going to be a big question he has to wrestle with. How is the CFTC going to approach DeFi? The last piece for the CFTC is the Clarity Act. And what the Clarity Act is moving through the House. The Senate is looking at parallel market structure legislation. And it doesn't entirely solve for DeFi, but it creates some more space to allow for non-custodial decentralized smart contracts to run. And that might be the beginning of what the agencies can look to as statutory authority to create some permission spaces for DeFi. I'm sure others here have thoughts on this, but that's the lay of the land.
Can I say 2 or 3 points of follow-up to that, Ryne, which was a great overview, which is, one, even from a technical perspective, for a long time, it's been very hard for the DeFi derivatives protocols to be truly decentralized. Frequently, you've needed keys to open vaults, right? And so sometimes the software developers will hold admin keys or hold special privileges just by the way these DeFi protocols work. They've evolved a lot over the last 4 or 5 years. So there are certainly some protocols that do function that way, but that's one thing to really keep in mind just from a regulatory perspective, that like if you do have some form of control, there is a high likelihood that the CFTC will look for you to have some type of obligations if you're offering derivatives in the United States. As Ryne said, most of these protocols block the US at this point in time. And two, I would say Brian has been very thoughtful. Brian Quintens has been very thoughtful in the industry. And I think for anybody building DeFi derivatives in the US, there's a real opportunity to go forward to be able to bring an innovation exemption or a real path forward for offering this in the United States. It may not be perfectly permissionless, but I think there are aspects of these protocols that aren't always like, you know, whereas we may see something like the Uniswap protocol have hundreds of thousands of interfaces and ways to access it. For these DeFi derivative protocols, sometimes there's not. And while the CFTC has focused a lot on the fact that these software developers create both the protocol and the front end, I don't think that necessarily means you fall under the CFTC's jurisdiction. But if you have done that, there may also be an opportunity to come up with a modified type of regime that the CFTC will find palatable so that you can bring derivatives back into the United States in a DeFi.
And
Rebecca, thanks for that. Ryne, just quickly, yeah, Ryne.
Can I drop one more point on that? One thing that I think the crypto community sometimes overlooks is derivatives exchanges it's a big industry in the United States, and DeFi outside of the United States has become very large. This will be a very competitive issue, and you've got an existing industry here in the United States that, while they've not cared as much about other parts of crypto gaining speed, there's going to be some strong resistance on the political side, again, from the competition perspective, around letting someone go forward with products that look just like the registered products, but that don't have to be registered.
So
So
Ryne,
I think go ahead.
Quick question on the Clarity Act. Is the idea then that rules can be promulgated so that people entering the space know very clearly which falls under, say, the ambit of the CFTC versus which falls under the ambit of the SEC? Is that the general idea?
I want everyone's thoughts on this, but I think the Clarity Act gets closer to answering that question for, transactions involving certain cryptocurrencies. Are those SEC or CFTC transactions? I think we get a useful answer around that. We don't get any definitive answers around things like DeFi, and I think that's intentional. And so where you've got something like decentralized exchanges, we're still going to wrestle with the question of where those plug into the regulatory environment.
Absolutely correct. And I think it's important to acknowledge that as any crypto GC or most crypto companies, obviously there's a huge focus on the US because there's a lot of risk in the US. But you also have to consider the global environment for DeFi. And we do have a lot of the laws in place, for example, MiCA being a great example, that have specifically chosen not to try to corral DeFi into this iteration. And I think that's absolutely by design, because part of the challenge with legislating around DeFi is that there's a spectrum within DeFi, and you don't want to put rules in place that are unenforceable. So there's a broader question that also, remains as to, okay, what rules should be applied to DeFi, if any? And then if certain rules are applied to so-called DeFi, because there is such a spectrum of DeFi, how do you ensure consistent enforcement? Laws are not worth the paper they're written on if they're unenforceable.
Katherine, thanks for that. We're going to, in the interest of time, we'll pivot away from regulatory for a second here. Amira, there are some projects being developed that are promoting and moving forward the DeFi space industry. I want to talk about Project Open for a minute. Could you just educate us upon what that is, Project Open?
Ooh, I feel like Rebecca will be well placed to speak about this as well. But
Fantastic.
Project
Rebecca?
Open is a high level, basically this idea that if you take a step back and think about the value and the promise of crypto and Solana in particular, right? The Solana original mission was to create NASDAQ at lightning speed, but globally, right? How do you create an open, permissionless blockchain where people can trade anything? And what are the things that are that a lot of the world wants to trade? Well, they're equities, right? And so we have this broad spectrum of equities out there. Traditionally, these are offered, or the most popular places are offered in are sort of U.S. Exchanges. And the idea behind Project Open is thinking about how we can start to offer more of those equities on chain, and basically like a set of examples or a framework for how we might be able to think about equity issuance on chain and trading on chain. And that's what Project Open is. So it's basically like a white paper that's been submitted by the Solana Policy Institute along with Orca and a couple of other folks in the space to create a proposal for how we might do that.
Thanks,
Yeah.
Rebecca. Yeah.
No, I'll just tee it up because I think Ryne has been in to see the SEC a few times with this Project Open group. So I'm happy to talk about it, but Ryne may have more inside baseball to share on Project Open in terms of what he can share. Maybe there's parts he can't.
No, I mean, it's a collaborative group. I mean, the public participants have been Solana Policy Institute, Superstate, which has the credential of being a registered transfer agent, and then Phantom as a non-custodial wallet provider, and Orca as a decentralized smart contract protocol. And so, if I'm missing anyone, forgive me. The SEC's posture is that, the industry and the staff there are trying to figure out what Atkins meant by saying innovation exemption. And I think initiatives like Project Open are working to put down on paper what an innovation exemption could look like. And I think we'll start to see some of those proposals come in hopefully soon. They'll probably be public. All of the crypto task force written submissions have been public.
Yeah, that's one thing I wanted to build upon. And I think Katherine sort of made this point at the outset, which is we're living in a very different regulatory environment. We can now have these discussions out in the open. And the quote unquote worst that will happen to you is the SEC says this won't work, but you should try it this way or that way. And then you can have ongoing dialogue. For a long time, as many people who are probably on this know, and all of us who are speaking know, if you went into the SEC to propose something 5 or 6 years ago, your best next step would be to expect to get a subpoena. And so there was no ongoing dialogue. But in the development of our capital markets in general, both on the SEC side and on the CFTC side, what has long happened is that the markets developed and our regulations built up around them, like even historically, right? The Commodities Exchange Act and many things in there. Same with the Securities and Exchange Acts, so the 33 and 34 Act, is they came up and built around the way the industry was. And now we have the opportunity to engage with regulators in a way that's really productive for the innovation that's happening. And for sure, we've seen this with the SEC, and I think we will certainly see this when Brian Quintenz gets into space at the CFTC. But these regulators are moving faster than any regulators I've seen to date. And so they want to keep pace with where the technology is being built too. So I think that's pretty special and we shouldn't overlook.
Rebecca, thanks for that. You reminded me of an incident I had with one of my clients maybe about 2 years ago now. I won't say the names, but the client, pretty well known in the industry, spoke at an industry conference and openly said to the SEC back then, 2 years ago, please give us guidance, please give us help. And then literally 2 weeks later, they got hit with an enforcement action. So things have moved on since then, please God.
Well, that could actually be a lot of your clients, probably. I bet that happened to a bunch of people.
Well, no names. Moving on. Rebecca, I'd like to talk a bit about the Genius Act. What are the implications for the Genius Act going forward? What's it going to do with stable coins? And I open question to this group. Why will they not allow issuers of stable coins, holders, to earn interest? I'd love to hear someone opine on that because I'm a little intrigued by that. No interest, no yield, but I'd love to hear. But go ahead, Rebecca. Thank you.
Sure. Thanks. So the Genius Act is the draft bill put out by the Senate by Senator Hagerty and with a number of others supporting, that is meant to bring stablecoins into the regulatory ambit in the United States. It will be a federal regime that will allow for regulated payment stablecoins to be issued in a way that I think gives users and participants a lot of certainty around them. I think given what we've seen on Twitter and heard in DC, that it's come out of the Senate in a bipartisan way, and it will probably go through the House in a bipartisan way and pass. The president has asked for the Genius Act to be put on his desk toot sweet to be signed into law. And he is importantly not trying to couple it with market structure and clarity, because I think there are probably some more iterations there and probably some more machinations that need to go out between the House and the Senate. In terms of why Genius will not allow for yield on stablecoins, I would say two different pieces of it. One is people believe that yield-bearing stablecoins may resemble securities. And without getting into the mechanics of whether that is or is not true, I think that was probably just the simplest way to try to get this through without scoping in the SEC or having a lot of issues around it. I think the second piece is Circle, who is a well-regarded, now very publicly traded company in the United States, allows for yield on their stable coins to happen through their partners. So it is not coming directly through them. So if you do hold USDC on Coinbase, you get lots of yield, but it's coming through Coinbase and not through Circle. And so they farmed this out, whereas other non-US stablecoin issuers do offer yield on their stablecoins more directly. And so this may have been a way to favor certain actors without directly saying so. That's inside baseball DC speculation. I could be totally wrong about that. But I do think that most importantly, it was a way to try to scope out the SEC and allow this to go through in a much more direct.
So a question for you regarding on stablecoins. This is an open question to the panel. You've been reading recently that Amazon, Walmart, maybe some others are developing their own stablecoins. Do you see this potentially as a threat to banks, to payments processes like Amex and MasterCard and Visa? Do you see that potential threat? I've seen some conflicting responses. Yes, it looks like a yes from Ryne, looks like a no from Rebecca. I'd love to hear your thoughts.
Ryne, you go first.
The banks will never let those companies offer financial services in any real way because they're going to do it much more cheaply and more efficiently, probably, than the banks. Now, if all the banks want to hire me to say that more politely, I'm happy to represent them. But I mean, there's something like industrial loan charters that was tried for years for non-bank things to get bank charters. I think I'm going back to competition on this one. It's a huge issue for the banks, and they're not going to let the Amazons and the Walmarts, who have all the customer bases and relationships already, to take over banking. And they'll argue that they can't do it in a safe and sound manner because they're too busy selling us, online books.
Rebecca, is there a counterpoint?
No, but one point I want to put out there is that stablecoins are just going to be cash. Like, they're just going to be cash. And so to differentiate from credit cards, like, yes, maybe some of us use credit cards in lieu of cash. We'll tap our Apple Pay or whatever that our credit card is attached to, but people do still use credit cards for credit. But stablecoins are not going to have that same feature in many ways because, you have to have something backing it. If you're holding it, you have to maybe acquire it in a certain way. But while it may function in some ways the same way as credit cards, it will not function in all the same ways that credit cards function. As far as like whether it will replace banks, this may be I have been the biggest proponent of DeFi for a long time, but I have long said DeFi is not replacing all of our financial institutions. It may change the way we deal with financial institutions, but like these have all been around for a long time. My mom, who lives in a small town in Illinois, is not going to be like, you know what I'm going to do? I'm going to start she's long used traditional financial institutions. She's not going to just like turn it all over and start using DeFi because, I don't know, it's palatable now. And so our financial institutions are always going to have a role in the economy, and it just may change over time. We're witnessing it on the ground floor, but it may just be these small changes that 10 years from now, people who are not involved in it day to day sort of see, but weren't watching, as closely as all of
them. So let's go there now.
So one thing to add to that, I just want to mention we're still really, really early. But I agree with Rebecca. I think most people in crypto are not evangelists, meaning they don't think that crypto is going to replace the entirety of the financial system. They think it's going to scale to a fully complementary asset class or a bigger asset class than it is now. They think it's going to create efficiencies within market structure, for example. But you also look at stables, there are certain kind of obsessions at any point in time when you look at crypto. And right now, some of those obsessions are stables, absolutely, payments, tokenization, Bitcoin treasury companies. Bitcoin renaissance. So who knows if any of these have real staying power? The other thing with stables is, of course, the US government is supporting stablecoins and the Genius Act because, you know, it really supports the continued dominance of the dollar, because the dominance of stables globally are dollar-backed stablecoins. So there's a lot more to this than just, you know, stables in isolation.
Well,
Can I, Jim, I
appreciate
know,
it, Catherine. Go ahead, Amira.
I know you're trying to move to the next question, but I'll add like a coda that I think is slightly counterpoint, but I think in agreement with everyone here, which is no, I don't think stables are going to replace banks or payment processors. But I do think if you're in charge of a bank or a payment processing company, you better be paying attention and figuring out how you're going to integrate all this into the work you do, right? So there's a reason that Stripe, Visa are waking up and figuring out these integrations and making major acquisitions in the space. And I think some of the most interesting companies emerging right now are banks figuring out, or sort of startups figuring out how they can create easy interplays between banking infrastructure and Web3 infrastructure. So I think in practice, what's going to happen is a lot of these systems are going to be abstracted away from the user, and we're just going to see a lot of stablecoin and DeFi infrastructure and generally just working on the back end. And I think there should be a push, rightfully so, to modernize if you're one of these companies.
So, Amira, thanks for that. I want to stay on that topic because, you know, if we had a crystal ball, if we put the crystal ball in front of us, how disruptive is DeFi going to be to TradFi? You know, in TradFi, in some cases, you have institutions with heavy fees doing quite well. You know, do we see DeFi eventually disrupting institutions or, you know, other areas in the economy where it'll start supplanting TradFi? I'd love to get your thoughts just to dig a little bit deeper because it's coming. We all know it's coming, but to what extent, I don't know. But maybe you have more insight.
I'm old, so I think about this from the perspective of electronic trading and how it's evolved over the years, and yet it's all still fully regulated and inside of TradFi. So you used to trade by calling your broker, then you can trade online, but it was just during the day and there was high fees. And now it's 24/7 and there's no fees, and it's as easy as opening an app on your phone. The transition into electronic trading made everything better and more accessible. And DeFi and blockchain is very much going to do that. And I think banks are going to adopt it. I guess I'm landing where Amira just landed. It's going to become part of offering financial services, and if not, then that type of bank won't continue to exist.
I mean, if I go to a Walmart and they have their stable coin, and if I'm using the stable coin to make a direct payment now from my wallet to a Walmart wallet, someone just got removed out of the process, right? So I think we're going to see, to your point, we're going to see more and more of this. What do you think?
I mean, I want to. There's got to be rules around. I mean, there doesn't have to be, but it seems like with the Genius Act, there's going to be rules around what a stable coin can be and how it needs to be structured. And I guess if Walmart's able to get that license, then there will be rules around their stable coin.
But we'll see. We'll see. We'll see. I want to touch on something quickly. One of the early knocks on the DeFi industry in the early days was AML. Rebecca, from your perspective, has this changed at all? If so, how much has it changed, and where do you see this going forward?
That's a great question. It has changed, actually. I think it has not changed as a narrative point, quite frankly, that people still love to say, oh, and these permissionless systems, like anybody's out there, so you can have all sorts of bad actors running through DeFi and you can't do anything about it. One, that's not true. Two, in direct discussions with federal and state law enforcement, they like DeFi a lot because they can trace things, and they actually need some additional, probably congressional authorization for people, especially including stablecoin issuers, to be able to freeze and do other things while they're tracing or trying to be able to get at assets. I think the other thing is there was recently a report that was authored by IBM Promontory and put out by the European Commission as part of the markets and crypto asset regulation. They needed to do a 1-year report on DeFi as part of the regulation. And they said that there used to be hacks and things like that for DeFi protocols that were the source of most of the illicit activity or the source of getting illicit funds. And they said as a cause for illicit activity, that has dropped more than 50% in terms of being able to hack the software. And now what is actually the larger driver of illicit activity is things that we see in Web 2, the same in Web 3, which is security protocols and system management risk. So one person is holding all the keys and that person can be compromised, or you don't have your website locked down appropriately or things like that. And so I do think that the safety and security of DeFi is changing, one. Two, there's a lot of organic efforts around stopping illicit actors. So things like the Security Alliance or SEAL, they have an ISAC, which is the same as what the financial services industry has in terms of information sharing about illicit actors. There's also a crypto ISAC that's going on. And I think that there are a lot of organic tools that can be used that come from the blockchain analytics companies. So I think the narrative around bad actors using DeFi may have not changed. It seems to be waning a little bit, but people love to sort of put it out in the open whenever bad things happen. But I do think the facts on the ground about bad actors using DeFi for illicit activity are changing, or is changing.
Great. Ryne, any thoughts on that from your perspective?
The government's been active in enforcement around illicit activity. And so the incentives, I don't know, for projects that are looking for a main scale audience or mainstream audience, the incentives are to try to solve for it and to get it right. So I think that's been helpful too.
Great, right.
I want to chime in on that. So my private practice background for many years before going in-house was government investigations and white collar. Most of my caseload was financial fraud, AML, sanctions issues. And those issues truly are existential. Like, I like to very broadly bucket the three biggest risks for crypto as security, hack, like smart contract integrity, or I should say for DeFi, regulatory, meaning civil regulators, SEC, CFTC, and then third, the criminal bucket, which is what we're talking about. And obviously, if you have an inquiry from DOJ and OFAC, it's very different in many ways than having an inquiry from the SEC. It's all hands on deck in an existential way. We always joked in private practice that we could charge the most out of any lawyers, because it's like you don't cheap out on your white collar lawyers when DOJ is up in your grill. So that all being said, I think Rebecca's correct. And I think the thing that we need to watch with DeFi is that we've come a long way from just major DeFi protocols saying we're permissionless. Like everyone knows that's not sustainable and it's not scalable. And there's more and more institutional engagement. We're seeing a huge wave of institutional interest and engagement in and out of DeFi and crypto. So the use of blockchain analytics, the use of zero knowledge proof technology. I mean, I could go on and on and on. All of these protocols, especially to the degree they are still centralized and they're on their decentralization journey, are really thinking proactively as to how to dissuade wrongdoers from using their protocols and how to effectively avoid facilitating the flow of dirty money.
Yeah,
Great, thanks.
You alluded to a point that, I mean, the technology is permissionless. It has to be. Like, the underlying blockchain technology has to be permissionless. Use cases and applications are not going to be. And permissionless is a really wide spectrum there. And I can hear some of our colleagues and friends at the bar, getting nervous when I say the applications can't be permissionless. But there's going to be a component of filtering, and it's going to be a spectrum depending on what the products are, the product set is.
So Katherine, thanks for that, Ryne. Katherine, I'll always stick with you. I'd love to hear a bit about what you did at Maple, because talking about permissionless in the pool, it was a very unique approach, what they accomplished there. Can you talk about that a bit?
Yeah, Maple's a really interesting case study. I mean, for those who aren't familiar, Maple is or was a DeFi protocol, but controversially in many ways, because Maple provided the infrastructure, the smart contract infrastructure for lending pools. But each of the pools had a different strategy. So some of the pools were permissionless, and some of them were fully permissioned, meaning KYC was performed on both the lenders and borrowers in the pool. Now, part of that was because Maple's core business when I joined was actually facilitating under-collateralized loans to crypto market makers. So you can imagine how that really went in 2022 and why Maple pivoted away. But what was very interesting and what was very compelling is even back then, we saw a lot of institutional engagement. Meaning hedge funds and larger, even regulated entities would use us as a way to kind of dip their toe into the DeFi ecosystem and they could get comfortable with a fully permissioned pool. Now, some people would not consider that DeFi, of course, because the definition of DeFi, as Rebecca mentioned, is there's a spectrum of definitions. Some people would consider it DeFi because there were smart contracts involved. In many ways, it was peer-to-peer. Others, not so much. I was obviously a big tent person, so I considered it DeFi. But I think it's an interesting, again, case study or a conversation starter as to what is DeFi. There's a lot of different ways of approaching it. And I liked it because I thought that there was a major contingent of institutions, entities, individuals that might not want to go 0 to 100, 0 to peer-to-peer, especially in crypto lending. And sometimes you need to have that median step for people to get engaged and get comfortable, or the gateway drug to engagement, the spot Bitcoin ETF mechanism to engage more broadly with the DeFi ecosystem.
Great, thanks. We've got a question. I'll just take it. It's a great question. And I've been reading a lot about the Genius Act and its potential impact on Tether. Some are saying it might have a really negative impact on Tether. So the question is from Ned Thompson. Ned, thanks for this. With so much of the market, do you see Tether changing the way they do business to adhere to the potential regulations put forth by the Genius Act? Anyone want to comment? Any speculation there?
I'll just mention that Tether's been very vocal about kind of focusing away from the United States. Like, they've made a series of comments about how they're going to focus on APAC and the Middle East and not the United States. And they've already had to do some pivoting away from MiCA because UST is not MiCA compliant. But sorry, I think Rebecca was going to say something as well.
No. All I was going to say is I don't think they'll change anything with respect to their day-to-day activities. I think that long term, especially given that we saw their CEO in the US on sort of like a tour of DC maybe a month or 2 months ago, I think they do have an interest on coming into the US. And so we will see efforts on how to do that coming forward. But I don't think they're going to change how they do business from an overall perspective. But they certainly will probably look at ways to come into the US in a compliant way.
Yep, smart. Okay, thanks, Rebecca. One of the topic that came up one of our earlier calls was the importance to get investors involved in DeFi, not necessarily a very large investor, more on the smaller side, maybe retail investors. Any thoughts there, how to make that happen? What is the importance of that?
Could you expand on the question a little more?
Yeah, the comment was made early on, one of our earlier calls, Amira, about getting investors involved in DeFi. I think meaning more mainstream investors as opposed to like the big house investors. Any thoughts there to maybe how to make that happen, or why would they want to do that, investors? And to me, it's all about obviously return and yield to a large degree.
Yeah, I without saying anything particular about, I don't want to make like a normative claim here about we should be getting more people involved in DeFi. But at the end of the day, I think what excites a lot of people about DeFi and the broader blockchain ecosystem is the ability of creating broader access to more products, to more people. And one of the promises of DeFi and the broader ecosystem is you can have access to products that normally have really high buy-ins, or they're geographically constricted, and so they just are more available to a broader swath of people. So one of my favorite projects that's been around for a while in the space is a project called Etherfuse, and what they've been doing for a long time is they make it possible for people to be able to access bonds anywhere in the world, right? So they do bond issuance on chain, and if you are someone who is, say, based in Nigeria and you want to be able to access Mexican bonds, they make it much easier for you to do that. Why would you want to do that? Well, if you're a savvy investor coming out of somewhere like Nigeria, the ability to buy something on the Mexican exchange is normally full of all kinds of red tape. It's very expensive. It costs a minimum of $100,000 to figure out. But you might see an investment opportunity that is interesting to you. And what they facilitate is the ability to do that for, fractions of the cost, maybe a KYC check, and then they make that available. And you're just going to see that happen much more, right? The ability of different equities to be issued on chain in different ways so that you could have more access to different types of products. And so that's to me the promise of DeFi, is the idea that we're just going to broaden accessibility of products that for too long have been siloed in certain markets or with people with certain investment ability.
Thanks for that. And any of the panelists want to comment further on that?
All right. I'll make a comment on tokenization, which it just jumps off what Amira was saying. There's going to be a lot of assets that don't have much traded activity now because it's hard to trade them. And if we get tokenization right and conventions and standards sorted out, and we know what we're trading, once you've got a digital version of all sorts of assets, you're going to see a lot more financial engineering and financial activity around them. Where that's interesting to a normal person is, hey, maybe I can use this as collateral for a loan, even if it's, the painting in my house. And the greater access to finance that you can get through tokenizing assets is, I think that will be an enticement for people to figure this out.
Great, thanks, Ryne. One area that came up, and I've been hearing a bit about this, I'm not sure if any of you have actually seen it in practice, though, is for an IPO actually offering the securities on chain. Love to get your comment on that. Has it happened yet? Is it just talk? Is it practical? Is this something that's possible? On-chain equities offering down the road, securities offering. What do you think?
I mean, that's what Project Open is working on, and the idea, the condition precedent would be a registered security, an S1 registered security, and you'd still you'd track ownership through a transfer agent, but instead of holding it through a broker dealer and at DTCC, you'd either hold it yourself or through a broker dealer that has their own wallet infrastructure. I think it's doable. How you trade it once you've initially purchased it is the question that we're wrestling through. But I think you can distribute the purchases. I don't know. I think you can distribute securities to wallets. You need a transfer agent, but I think it's doable.
Okay, and to the extent that maybe will it eliminate the need for an underwriter? I don't think so. I think we still need underwriters, I would think.
The financial ecosystem around getting an offering to the public markets is not going to go away. I think it's how we plug in wallet infrastructure as opposed to stacked broker dealers, or maybe broker dealers integrated with wallet infrastructure. Those are the questions to answer.
Right.
And it's interesting, Jim, relatedly, although different. I mean, I'm in Cannes right now for ECC, and Robinhood made a big announcement tonight that they're expanding its crypto offerings by launching tokenized stock trading. And I think this is the third or fourth entity that has made a similar kind of announcement in the past month. It's not an IPO on chain, but it's stocks on chain. And so obviously this conversation is happening. What are the advantages? What are the advantages economically? Some of them are obvious, 24/7 trading, for example. The one point that needs to be made on this webinar is that it's very different than crypto assets. Like tokenized equities are very different than the gray that exists with crypto assets and the taxonomy of crypto assets. And I keep seeing and hearing people conflate the two, and they couldn't be more fundamentally different. Tokenized stock, those are securities. And, entities overseas, I'll note that all these entities are only offering tokenized stock to EU customers, not US. Many of them have extensive licensing overseas, like MiFID II licenses, et cetera. So it's a very different regulatory regime when we're talking about tokenized stock versus trading crypto assets.
But Katherine, to your point, do you see a day when here in the US, there is groundwork laid so that we can tokenize equities here and trade them as securities? Yeah, okay.
Oh, yeah. I mean,
Yeah.
I think it's inevitable, but I think our regulators have a lot of wood to chop.
Great.
And that's one of a long list of issues and product offerings that they need to work through.
Great.
And of course, we all need to recall that a lot of the clarity that we're getting, a lot of the rulemaking, a lot of the communication, that it's not law. So, that is one of the things that makes me a little concerned if we don't get a market structure law. This could all change again if there's another change in leadership.
100%. Exactly. Got some questions, so I'm cognizant of the time here. Let's just read some quick questions. Roman Beck, I'm curious, how could interoperability among permissionless blockchains alter the competitive dynamics between centralized and decentralized stablecoins? I don't know if anyone wants to tackle that. I am curious how interoperability among permissionless blockchains alter the competitive dynamics between centralized and decentralized stablecoins.
Yeah, I mean, Katherine probably feels this deeply because StarkWare is working on many different types of interoperability. So, but what I will say is that is one of the biggest things that we have to solve. The way that our Web 2 internet works today is very seamless, HTTP, SMTP, and we're not like, oh, do I have to like shift over into one underlying network to be able to use the internet? No, I open my browser and I just type in whatever I want to do. And we keep forgetting because blockchain has been so highly politicized, and the questions around regulatory have come so much to the fore, but like it really is just meant to be the underlying network to the internet, and the applications change how we do all sorts of things, whether it be financial, social media, whatever on the internet. And so we need to figure out the interoperability question, because you can't keep having to switch from like one layer two to another, or ETH to Solana, or whatever it may be, in order to use certain types of applications. So that's a big challenge to solve generally. I don't think it matters centralized or decentralized. I think what matters is that you can have a seamless experience regardless of, you know, Robinhood choosing certain L2s to launch on, Kraken choosing another, and those are both for tokenized equities.
Right.
And the beauty of DeFi, I'll wrap it up, Jim, real quick, but the beauty of DeFi is the seamlessness of the liquidity that changes the way our markets work, which are very fragmented today. And so interoperability will be a key part for ensuring that the seamlessness of liquidity continues.
I think what Rebecca's saying, and I agree, is that we should just use Solana.
I agree with
Okay.
that too. Yeah.
I
Moving
do
on,
not
quick
agree
one.
with that.
All right, moving on,
I
quick
did
one.
not say
Can't the issuer of the IPO elect to act as its own transfer agent and rely on the token smart contract to do the record keeping for transfers? Probably right. That was by Joe Diana. He's probably correct there.
I think
Can't the issuer of the IPO elect? Go ahead, Catherine. You're good. Okay, you're going to respond to it. Okay.
Oh no, I think Ryne was going to go ahead.
There's a path that you need a transfer agent. I'm not going to speak over my skis there. There's probably a path to that.
All right, fine. Just a few minutes left. It's been fantastic content. Great from everybody. Great participation. I can just go around the dial. Start with, we'll go with Ryne, then we'll go with Katherine, Rebecca, Amira. Crystal ball, put it in front of you. A couple of sentences. Where do you see DeFi in 5 years from now?
Yeah, when we're going to get meaningful exemptions from the SEC and the CFTC to really start to bring these products to market in the US, and then it'll be mainstream in 5 years.
Katherine.
I'm not quite as optimistic. I think it's going to take more time. I think DeFi's problem has always been that it's too early, but I think we'll see more institutional engagement with DeFi in 5 years, which will also facilitate DeFi's growth. And it will be good, but it will come with sacrifices.
Thanks, Katherine. Rebecca.
I just don't even think we're going to think about it in 5 years. It'll be integrated with some of our financial services.
Seamless.
It'll be seamless. Like we just won't even think about like, is this DeFi or not? But I think, as Katherine said earlier, there is a lot of wood to chop before we get there. But 5 years from now, it will be integrated in many ways in our financial services.
Totally agree. Amira?
I think that's true. I think this panel, I mean, it's already sort of like over, it's outreaching like the reach of what DeFi is. Like DeFi means so many things already. And so I think there are components of it that will reach breakout use cases that make a lot of sense for broad consumer base. And that stuff will be integrated into our financial system in ways that we don't see it. And then there'll still be a bunch of people using sort of like clunky DEX UIs to figure out how to do like really crazy things. And we'll just see some kind of bifurcation or lots of different experiences there. But I think a meaningful part of DeFi will be integrated into our everyday experiences.
Exactly. And I keep asking myself, what impact, if any, will it have on banks? What impact, any, will it have on payments processors, on credit cards, on, things that we use on our daily basis in our lives? What impact is that going to have? And I think I agree with all of you. It's going to have an impact one way or another, for sure. Okay. Phenomenal panel. Thank you, everyone. Great content. Really appreciate all your participation. Karen, are there any closing remarks we'd like to make for the BBA wrapping up?
Yes, please volunteer. Please reach out. Please look for future events and let us know what kind of topics you're interested in hearing, having like these virtual panels today. And if we should have a follow-up DeFi in person. We would love to do that in Boston and have some esteemed guests join us.
That'd be
So,
great. I want to be
thank you.
inclusive. We have one more question. Is a tokenized asset any different than a digital copy of a share you already own? It just seems like we have already, it just seems like what we have already with a different label.
Well,
Catherine, I see you smiling. Ryne, what do you think?
It's the share. It is the share. It's not a copy. It's the share.
Okay.
It also can move differently in different ways once it's tokenized in a way that digital shares can.
That's the whole point and the value.
Great.
We were talking about this evening, and one of the things that really resonated with me is you look over the course of the past 10 years. You have banking crisis, the black swan event in the FX markets, like even Lehman, like, okay, all of these insane environments where some of TradFi will be like, people don't want 24/7 trading. And it's like, yeah, but they do in certain circumstances. And there would be enormous value to have all of this on chain in events like that in particular. Now, those are extreme examples, but there's a lot of validity of accommodating for a global 24/7 environment.
Awesome. Fantastic. Thanks, everybody. Aaron, we're good?
We're good. Thank you.
Awesome. Thanks, everybody. Thanks so much.